We've got to talk about the housing market because we've got some massive problems. A little bit of good news, but some massive problems and some cracks that are showing. And in this video, I'm going to show you some things you probably haven't seen before. So let's talk about what's going on with the housing market and then potentially try to understand why it's happening and maybe cast out how long do we think this pain could potentially last for the housing market? When would it begin, first of all? Then when we actually think it's going to end, and where are the opportunities to buy or sell or refinance real estate. Let's get into that right now. Quick note, this video is brought to you by the programs on building your wealth, link down below, including an amazing course on do-it-yourself property management, rental renovations. That's a phenomenal course for helping you out with liability, saving thousands of dollars. We've got a partnership with Lowe's for home improvement, gets you a lot better pricing. So check that out, link down below. Of course, if you're an agent, I think it's a great time to become an agent, link down below. Got a course for real estate investing. If you've never thought about investing in real estate before, 0 to millionaire real estate investing, all linked down below. You can even bundle these together. There's a coupon expiring at the end of this month, and we'll have our largest price increase ever after that when prices start going up. Also do deal analysis in our 0 to millionaire course. So if you submit a real estate deal for analysis because you've gone into escrow, I'll personally take a look at that and give you my sincere opinion of your deal. So take a look at that link down below. Okay, folks, so the first thing that we've really got to pay attention to with real estate has to, of course, do with inventory, because we know that inventory is at substantially low levels. But what we're concerned about is the potential fear. Okay, this is very hard to quantify, but this will make or break the real estate market. And so that's why I'm going to start with this. The thing that you have to be concerned about is people who own real estate getting fearful that prices are going to come down and then deciding to sell their real estate. That is the most important distinction. Now, when people hear that, they think, oh, but wait a minute, Kevin, but if you sell, then you have to rebuy. Wrong. If you're a homeowner and you sell, you could rent. Also, you don't have to be a homeowner to sell. You could be an institutional owner of real estate, or you could be an investor in real estate. And we don't need 100% of people to decide, do we want to sell or not? What we really only need is maybe an additional 1 million homes, or maybe an extra 10% of homes to sell, and all of a sudden you have a completely different inventory dynamic than you previously did. So one of the first, and in my opinion, most important leading indicators of pain coming to the real estate market is what's happening with new listings. Now, this is market by market. I'm going to show you where you can look this up. This is very early, so we're not going to get crystal clear data yet, but you want to pay attention to what I call inflection points in the real estate market. You could do this with your local MLS by talking to your real estate agent, or you could just use the Redfin Data Center. Just know that the Redfin Data Center is about 2 to 3 weeks delayed, so if you want accurate week-by-week information, you should talk to your agent about this. But take a look at this. You go to the Redfin Data Center. At first glance, you don't really notice anything scary, because if you go to new listings, you don't notice anything that is breaking trend. And what you should do when you look at this trend is you should uncheck the 2020 box, because we want to compare to 2021, 19, and 2022. There's too much noise in 2020, and that makes sense. But what you want to be watchful of is when you start seeing stuff like this. Go to a hot market like Austin, Texas. Very hot real estate market. Austin labeled the #1 place to live in America by multiple different magazines. People flocking there from California. A lot of really incredible bullishness on Austin. What do you notice here? An above trend break in new listings. And this is something that we should be concerned about in terms of starting to pay attention to, because this is a 4-week line, which means it's kind of like a moving average. It's not an exponential moving average, it's a 4-week moving average, which means for you to break trend this substantially on a 4-week smoothed out line, your latest data points have to be substantially higher. And that is a trend that you want to start paying attention to. When you start seeing these new listings in various different cities, break trend, break trend, break trend, break trend, that's when you start getting concerned. This is not happening broadly yet, but you're starting to see some of the inflection points. And again, it's a 4-week moving average, so it really is going to take some time, but it's one of the first things that we want to start paying attention to. What's another leading indicator for problems in the real estate market? Yes. Well, another very popular leading indicator are new home sales. New home sales are really unique because new home sales are tracked based on when homes go under contract, whereas regular resale homes are tracked when they close. So that actually means if you want to get more recent data about the state of the market now, you look at new home sales. And let me show you the estimates for new home sales from the prior from the prior month. We were expecting to get somewhere around 750,000 new home sales. This chart you're going to see right here is the spread of expectations for new home sales. So when I hide myself here, this shows you that right here, this was sort of the average estimate that new home sales were going to come in at 750,000. Some people thought it was going to come in at, say, 765. Some people thought closer to 700,000 in new home sales. But everybody was pretty convinced that we were going to be somewhere over here. You could see the bell curve right here of estimate puts us somewhere about 745,000, right? Look at where new home sales actually came in. And this is absolutely mind-blowing. And I do want to say, because I see the question, yes, my programs on real estate do help internationally as well. 90% of the content applies. You'll have to make some adjustments for taxes and loan types, but the real principles of building wealth are going to apply to all markets, especially in terms of like how to renovate and things like that. Now, take a look at this. This is scary. This is like, oh crap. This is where new home sales actually came in. Way over there at 588,000. Nobody was freaking close. It's such a bad freaking miss that you literally have the analyst writing, yesterday we saw a horrendous new home sales number, nowhere near expectations, and at the number, the lowest reading since April of 2020, this may be the beginning of a trend. Okay, we need to talk about that. We need to talk about April of 2020, but I need to give you a quick reminder that if you want to get up to $1,000 in totally free stock with Public, make sure to go to metkevin.com/public. We'll have a link in the description and down below. Public is a company that does not use a payment for order flow. When you sign up and deposit any amount, you can now get up to $1,000 in totally free stock just for signing up. Public is a social platform where you could actually follow me on Public as well and see commentary from either myself or other individuals. I'm Meet Kevin on Public, but make sure, most importantly, first and foremost, you go to metkevin.com/public, sign up and get yourself up to $1,000 of totally free stock. And remember, no payment for order flow. They don't sell your data, and they provide a lot of neat information. And it's a great and really easy app to use. Check them out. And they even do crypto. metkevin.com/public. Okay, let's go back for a moment to, not that, to this right here. Okay, also not that. One of these buttons. There we go. Let's go here. So when we talk about this being the worst since April of 2020, why was April of 2020 so bad? Well, April of 2020 was uniquely interesting because we locked down and everybody had a substantial fear that the real estate market was going to face a wave of foreclosures and that the market was going to crash. That did not end up happening because we ended up getting mortgage forbearances and people were essentially able to not make payments on their homes for up to 18 months. Take that extra money, add it to the back of their existing loan, and then potentially refinance the entire loan from a 30-year mortgage to a 40-year mortgage, which means you have actually lowered your payments. Now, foreclosures are a big concern, and this is where a lot of folks ask me, Kevin, are we going to see a wave of foreclosures like we had in 2008? I believe the answer to that is no. That's because the average credit score of a buyer in 2008 was 670. The average credit score of a buyer today is 100 points higher, in the range of 770. That makes it much more clear that the people buying homes today are your wealthier demographic. And we know that wealthier demographics right now actually hold substantially more cash and therefore more purchasing power and more of a buffer than the lower income demographics that we have. You could see on screen here, top 20% have substantially more household income than the bottom 80% of individuals. It's also worth noting that the typical net worth of a homeowner is somewhere in the neighborhood of $170,000 to $180,000. The typical net worth of a renter is about $5,000. So first of all, that should be a hint to you that you should absolutely get into home ownership. Definitely check out the programs on Building Your Wealth Through Real Estate link down below if you're clueless as to how to even get started in real estate, or maybe you know a lot about real estate and you're like, okay, maybe I can learn more. You can. Will we see a foreclosure crisis though? The answer, in my opinion, here is a solid no. I don't believe we're going to see a substantial foreclosure crisis, and foreclosures, even though they're up from year-over-year numbers where we had a foreclosure moratorium, and this is why you have to be careful about foreclosure clickbait that we see online. So people are like, oh my gosh, so many more foreclosures than last year. Well, yeah, well, because we had none last year. We're still at about half of the levels of foreclosures now than we had prior to the pandemic. The reason for this is thanks to the ability to repay rules and Dodd-Frank regulations, it's very difficult now to qualify for a home. And generally it's the higher income demographics who are qualifying for homes. Those are the people with more cash and who are more resilient to inflation because they have assets. Now, does that mean that real estate prices are going to keep going up? Well, in my opinion, not necessarily. Just because we are not necessarily going to have a wave of foreclosures does not mean that, in my opinion, we are going to see the real estate market get out of this economic slowdown scot-free. In fact, Lowe's gave us a little bit of insight into their research. They told us that they believe we have at the moment, or at the first quarter of the year, we have somewhere between 20 to 28% excess demand for homes. That is the opinion of Lowe's, and it could be anywhere in that range. Interest rates have gone up about 3% for the average buyer since the lows that we had. Maybe somewhere between 2.5% now because interest rates have slightly ticked down again a little bit. But we think that as soon as the Federal Reserve starts their quantitative tightening, we're actually going to see treasury yields increase even more than we have previously, and we could end up having those 6% mortgage rates again. Quantitative tightening starts June 1st of 2022, and I wouldn't be surprised to see the 10-year treasury rise once we actually start having waves of tightening. And we're not going to have our most severe tightening until 3 months after June, which is actually September 1st. That's when we're going to start seeing our more severe tightening, where we're really tightening to the tune of $95 billion a month. But anyway, every 1% that mortgage rates go up, we know that buyer purchasing power goes down by about 10%. Well, if interest rates have gone up 2.5% to 3%, then that means all of this excess demand in the range of -20 to -30% is probably going to weigh and eliminate all of the excess demand to maybe where now at these higher rates, we actually have a stable market or a market where prices might be prone to come down about, say, 5%, right? Roughly in the middle here, making an estimate. Maybe that means prices come down at the end of the year by about 5%. Well, that's nominal. That's not a reason to sell, right? And it's also difficult to refinance right now because rates have gone up so high. Probably a better thing to do is getting like a home equity line of credit because those are usually variable interest rates. And so when rates come back down, those will come down again, which I suppose you could do with like a larger refinance as well if you wanted access to capital. But in my opinion, now's not the time to buy. The time to buy is once we figure out what direction the real estate market is going to go in. I personally think best case scenario, we're somewhere between a 0 to -5% decline by the end of the year because of excess demand getting crushed via interest rates solely. However, folks, what is, well, let me finish also the thought that should you sell? Probably not, because it's going to cost you somewhere between 7 to 10% to sell. That's because you've got real estate commissions of between 4 and 5%. You've got escrow and title fees of somewhere about 1.5%. You're probably going to set aside 1 to 2% in repairs. You're going to have vacancy costs. All of that stuff adds up to about 7% in selling costs. So like selling real estate is expensive. Like if you have to pay a tenant to get out, that adds to the cost as well. All that stuff is expensive. So like if you're selling real estate, you're giving up 7 to 10%. So probably not a good thing to sell if you only think prices are going to come down 0 to 5%. Do we think they're going to come down 40%? No. I don't think we're going to see a 2008 again because we have a different quality of borrower. So what is the thing that changes everything? Well, It's this right here. It's what we started with. It's inventory. If inventories, like if excess demand has been eradicated because of rates, but then inventories skyrocket, problems. That's when you get actual problems. And that's, in my opinion, where you could see a real estate decline anywhere in the range of -10 to -25%. That's my expectation, somewhere in that range. Nowhere near that '08 level. This would really, like 25%, this would really take a panic of like Tucker Carlson going, oh my gosh, real estate's plummeting, this, that, whatever. Investors starting to dump, trying to like sell at the top or whatever, right? That's that 25% fear. That 10% is probably, in my opinion, my base case scenario, that we're gonna see about a 10% sell down, which means if you sell, costs you 10% to sell, you kind of like broke even, right? Depending on, of course, when you sell. So those are my thoughts for the coming real estate crash. And if you want to dialogue with me or me look at your deal or kind of talk about that, check out the programs on Building Your Wealth, a link down below, especially those real estate ones. And do remember that I think there's a high likelihood of inventory being the driver of these moves. So pay attention to that inventory statistic. Watch what the 10-year Treasury does when we start seeing the tightening cycle. And then you're gonna know a whole lot more about what's coming to the real estate market. My thoughts. Thanks for watching. All right. What else?